Welcome back to James Talks Property. If you're new here, this is my series all about helping investors and wannabe investors grow their knowledge and understanding of the UK property investment market. If you're not new and you're following the series, then welcome back. This episode is all about the buy-to-let property investment market. Here we'll dive deeper into the buy-to-let investment strategy. We'll talk about how we can get the best out of it and maximising your returns in the long term. Don't forget to like and subscribe to the video if you like the content. So, what is the buy-to-let investment strategy? The buy-to-let investment strategy is a strategy where you buy and hold investment properties. They could be houses or flats rented out on a long-term basis to tenants. Those tenants could be professionals, families, or whoever you want to rent the property to on an annual basis, so they pay monthly as a standard AST. It's important to know that this strategy isn't a get-rich-quick scheme. You will make a small profit in the short term. That might be a few £100s a month in terms of rental profit after you paid for everything. But the big thing with this is the opportunity to build your wealth steadily over time through the appreciation of the asset and leverage. So using the bank's money and mortgages to build your wealth in the long term. Obviously in the short term, you will make some profit, but this strategy is really focused on long-term wealth creation or building on your wealth over time, benefiting from this asset appreciation. So just remember, it's a marathon, not a sprint. I see a lot of first-time investors get worried after their first investment because they're not changing their life immediately. However, once you give it a year or two, you'll start to see the benefit of the rental growth and the appreciation of the asset, and you'll see the opportunity to scale the portfolio. So, how does this work? Essentially, buy-to-let investment is one of the more passive investment strategies, but you'll benefit from the long-term appreciation. If we look historically, on average, the average property doubles every 10 years or so. So if we go with this logic, we'll be able to build our wealth steadily by using mortgages. Just because something has happened in the past doesn't guarantee that it will continue to happen in the future. For example, I don't believe that London will have strong growth moving forward. And if we look over the last few years since 2016, the growth has been minimal there anyway. The reason for that is affordability. In London, the average property has got to a position where it's too expensive for the average person or the average couple to afford the average home. That means that prices have hit a ceiling and we need to give it time to allow salaries to increase enough where this demand then increases again. This is why we're seeing a lot of people who are based in London invest in property before they even buy their own home, because they have 50, 60, 70,000 pounds worth of cash that they want to put into property, but they can't get residential lending on the homes that they'd like to purchase in London. So they're putting that money into other locations across the country in which they can see a return on their cash. They can benefit from appreciation over time, and they don't have to necessarily do that through their own home. Let's look at an example and see what capital growth can do for you in the long term. You buy an investment property for £200,000 in somewhere, let's say Manchester. To purchase that property, you'll probably need somewhere in the region of £70,000. That'll be a 50 grand deposit, plus things like stamp duty, legal costs, broker fees, and some other stuff there. In the short term, you'll earn a small rental profit. That might be £300 a month profit after you've paid for your mortgage costs, your management, and a few other little things. But remember, this is not where we build our wealth. In 10 years' time, let's say again, property prices double over the next 10 years. That property that you bought for £200,000 will now be worth something in the region of £400,000. That means all of that growth from £200,000 to £400,000 is equity that you now own within your property portfolio. So that's £70,000 that you have put into a property. £20,000 or so of that obviously went in fees. However, that has now grown to £250,000. The 50 grand you put in as a deposit, plus the £200,000 worth of growth in that time frame. So you've got £250,000 of equity in your portfolio. What you'd actually do though, is you'd probably refinance after 5 years rather than wait 10. And the reason for that is if you can refinance after 5 years, take a chunk of cash out of that property, you will then have enough for a deposit and fees for your next investment property, and then have 2 properties growing in value over time rather than just the one. You can essentially then just rinse and repeat this cycle to refinance every 5 years or so, release equity, use that equity to purchase more properties and grow towards an end goal. This essentially means the earlier you start, the better, because you can benefit from this compounding effect as early as you can. Although this can sometimes be a little bit difficult to get your head around at first, once you see it in person, it becomes obvious on why you would do this moving forward. One thing I do for my clients personally is go through portfolio forecasting to show them what their portfolio might look like in 15, 20 years time. And it's always really interesting to see people's reactions and how positive they are about what the future can hold if they do the right thing, be patient, and build their wealth over time. So, even if your goal in the long term is an income, you need to focus on the appreciation of the asset and the portfolio at first. So capital growth should be your priority. The reason for this is because you'll focus on capital growth, you'll hit an equity target, and then once you hit that equity target, you can focus on moving the portfolio around to focus on that long-term income. But early days, when you're growing and when you're scaling, you want to grow as much as you can do, use as much leverage as you possibly can do without feeling that you're taking on too much risk, and benefit from the appreciation of the assets, as well as using the bank's money to build your wealth. You can always focus on cash flowing assets in the future. That could be things like HMOs to supplement the overall portfolio. But in the early days, it makes sense to focus on growth, focus on the income in the future. And that could be by reducing debt or getting rid of your debt altogether and focusing on that income then. But early days, we need to build as much as we can. So how do you maximize the success of your buy-to-let portfolio? The first thing is location. The reason for this is just because property can grow in value and probably should grow in value in the long term doesn't mean every place will grow the same. So that means you need to pick a place that has strong fundamentals, that is big employment, institutional investment, a place that's already attractive for home buyers, but in the place that's becoming more and more attractive for home buyers in the long term because of things like universities, schools, restaurants, cafes, bars, things that make life easier, transport links, and those transport links could be local, so a local tram network, or it could be national, so direct trains into London within X amount of time. It could be international travel. Is there an airport there, or is that airport increasing in size, which means that demand is going to increase for people flying out of that airport, and so on and so forth. So if you're an investor looking to buy a buy-to-let, I personally would avoid London for the time being because of the lack of opportunity for growth because of affordability. I would target locations that are affordable, but not necessarily the most affordable locations in the country. Sometimes what you'll find is if you buy at the bottom end of the market, you see a lack of growth, and the yields are better in locations where there has been a lack of growth because they reflect that lack of appreciation over the last 10 years. Secondly, you obviously need to look at rental demand. Rental demand is obviously important when buying a buy-to-let property because you need to rent the property out so the tenant can pay the mortgage each month moving forward, and you can benefit from the small profit each month, but the appreciation over time. The good news is there's a lot of locations across the country where tenant demand is high. We've got an aging population, we've got demand increasing for rental properties every year, and we're not building enough homes as a nation, which means if you carefully pick the location based on those fundamentals and based on the demand for the area, you're onto a winner. One thing you need to be aware of when buying a buy-to-let is whether you want to buy with an interest-only mortgage or a repayment mortgage. Obviously, everyone's situation is different, so I'd speak to a mortgage broker when you have the opportunity. But for most investors that are looking to scale a property portfolio, it makes sense to buy with an interest-only buy-to-let mortgage. There's a few reasons for that. And the first is your cash flow will be better on an interest-only mortgage. This means that you'll have a little bit more wiggle room for things like maintenance. And secondly, because you're going to release equity from the property portfolio anyway, every 5 years or so to scale the portfolio, a repayment mortgage doesn't really make sense. To conclude, just because property should grow in value in the long term doesn't mean that you should forget about the value that you're paying for right now. Don't overpay just because prices are likely to increase. And even better, if you can buy at a discount, then brilliant, because you're getting immediate equity at the point of purchase. You'll obviously get a mortgage at the value that you pay, but you'll have that wiggle room so you can release equity when the refinance comes in a couple of years. So that is all you should need to know when starting out to look at buy-to-let investment properties. Let me know if you have any more questions. I'll see what I can do. See you next time.